So there's just every time something new comes out, there's a bit of a scramble from a financial planner's perspective to kind of assess what the impact is. And the most recent budget proposal that came out, I think most of the chatter that I received was on the introduction of the increase to the inclusion on the capital gains tax.
Mm-hmm. Yeah, I think that's a kind of the really big one that I was speaking with clients about that have investment properties. They're, debating whether to liquidate this year or not, whether to put it up on the market because their term is coming up, and just where the market is as a whole, whether they're interested in holding that. And I, subset where they, decided to hold it. And then others were, instead of delaying till later on in the summer to list their listing, right away in hopes of being able to get a sale and line it up before that deadline. For those listening, I mean, the June 25th deadline, is there clarity around whether that it's just when the purchase or sale agreement is signed, or does it have to have closed by then? Any idea on that, on those stipulations?
I have no idea. My understanding is when I place like an investment trade, for example, it's when it's initiated. So it would likely be the closing date as opposed to when somebody moves in. So I think that a closing date would probably need, but I don't have confidence in that.
Got it. Maybe you can kind of, and I know you had, we were talking about just before coming on, you had a great kind of breakdown in your newsletter last week about it, about the differences in that and kind of going through that increase of the capital gains and inclusion rate. Maybe kind of touch on for people what that implication and change is and how it breaks down for both the individual and then those that hold maybe an investment property in a company.
Yeah, I mean, two big differences holding it individually and in a company. A individual has a $250,000 leeway threshold on the increase of inclusion. What this means is if you buy something for $15 and sell it for 20, just to use a simple example, that would equate to a $5 capital gain. Now, your first $250,000 of capital gains in any given year is exempt from any of the increases that are being proposed in this budget. So the way that a capital gain works is, under current rules, is only half of the gain goes on your tax return. So 50% is the inclusion. So if you bought an asset for $15 and sold it for 20, you would have a $5 capital gain, and half of that, $2.50, would be included on your tax return. That still is going to be in place for the first $250,000 for those incurring capital gains personally. Anything after $250,000 in a year is going to be 66% included instead of 50. And so where this is impactful on real estate, with an investment portfolio, a planner can decide, okay, well, we're going to incur $249,000 worth of gains personally to stay below that threshold. And then next year, we'll kind of pare this back and do some more. But with a property, you can't sell one house per year every 5 years to dispose of it. It's an illiquid investment, an illiquid asset that has to be disposed of in its entirety. So if you've purchased this asset and it's appreciated, significantly past the point where the gain itself is over $250,000, that's where you're going to feel the impact.
And so that's on the individual side. But I believe it's, on the corporate side. And then this isn't just investment properties either. This is for people that have cottages or anything like that. So when they kind of came out with it, when they came out with it, talking about this is only going to impact, I think it was like 0.13%. They tried saying, but really it's impacting anyone that has a cottage that maybe inherited that cottage or that's held it for many years, because it's typically held, a second home held for an extended period of time. It's impacting those individuals that, might be something they're handing down or that they hold and it's part of their retirement plan.
Yeah, I think there's some smart people that do these things, but there are always going to be unintended consequences for who they're trying to go after and who ends up maybe kind of feeling the brunt of this a little bit more than what was supposed to. There's a few examples I can give if you're interested. Those that own property in corporations, there's no $250,000 threshold for the inclusion rate. So the increase is going to be from 50% to 66% included on any dollar, any capital gain, irrespective of how much. But there's even a nuanced other sort of fallout from this is, when you sell an asset in a corporation for a gain, half of that previously was taxable, and the other half actually goes into what's called a capital dividend account. and whoever owns that company can withdraw that money from the capital dividend account tax-free. So in the example I gave, if you have $20, if you bought an asset in the corp for 15 and it's worth 20 and you sell it, you have a $5 gain. Under previous rules, half of that, $2.50, was taxable, but the other $2.50 went into a capital dividend account that you could withdraw as an individual from a corporation tax-free. With the increase in inclusion rates, you're going to have 66% included, so only 34% will go into a capital dividend. So you're kind of getting dinged on both ends, in my view. So that's not ideal.
Yeah, I think kind of what you kind of alluded to is that I think the change was meant to go after a certain subset of individuals they kind of considered as the ultra wealthy, when in fact it's, hitting everyone from, of all different income classes that maybe either like I said, inherited something, that they're getting taxed on, to those that have a professional investment portfolio, whether it be equities or real estate.
I know people that just bought a rental property, smaller town, et cetera, and this is part of their retirement plan. And they have a couple properties that are taxable to them. And when they sell them, they're just going to have to pay more taxes than they thought they would otherwise. And this rule change wasn't intended for people like them.
No, it's kind of ironic that the budget is focused on housing. Was the main goal is increasing the housing supply for rentals and for resale, but bringing in, increased taxes on real estate kind of is going against what you're trying to accomplish, right?
I think they're really pushing it for the first time home buyer, right? Because they're allowing everybody to buy that first home, and the home that you own and live in is a tax-free asset in Canada. So they're basically saying buy one home, and they're making it a little bit more difficult to have assets outside of that as part of your plan, whether that's real estate or otherwise. But certainly real estate would have a bigger impact because it's an illiquid asset. To dispose of, you have to dispose of the whole thing.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe, because we'd really like that.